Hi, everyone. Today, I just want to answer a question that has been coming up lately, which is why diversify? S&P 500 has done really well. Again, it was a leader among investments last year. So why diversify away from anything but the S&P 500? Just a quick disclaimer. This is just general education. If you have any specific questions about your specific investments, please reach out. We're always happy to talk to you specifically. The first thing that I would just say is understand how asset classes behave differently from each other in order to understand how they fit into your overall investment portfolio and your purpose. So this chart is a correlation matrix that shows how asset classes are related to each other. The important thing about choosing different asset classes is how they behave differently from each other. So what you can see here is look at U.S. large cap stocks specifically. This is a good representation of the S&P 500. And if we look at stocks in general, tend to be pretty highly correlated, especially over the last 10 years. Small cap stocks, foreign cap stocks have a high correlation to large cap stocks. So we're not maybe getting as much diversification going into small cap and foreign as we are just staying in the S&P 500. But if we look at U.S. government bonds, U.S. corporate bonds, now we're getting some non-correlation here. And the whole idea is that when there's volatility in the stock market, these other asset classes should be moving in a different direction. The question if I want to include other asset classes in my portfolio is really, what are we trying to accomplish? What is your target? As you look at this chart, it's really messy. The message of this, all these colors represent different asset classes. So the dark blue you can see is U.S. large stocks. Again, this is probably best representation of the S&P 500. But we also have corporate bonds and treasury bonds and real estate. If you were to pick a color on what to invest in, this is really random. So if you're just invested in the S&P 500, you can see in most years, you're not getting the best performing asset class. There have been a few years where it's been the best performer. So how do you choose? Well, if we take the same chart and we overlay a balanced portfolio, so a diversified portfolio of all of these asset classes, you can see the pattern here is that it's a pretty smooth ride. Now, it's never going to be the best performer, so you're always going to have asset classes beat your diversified portfolio, but it's smoothing out some of the volatility by diversification. That's what this chart shows. So, consistent returns may be easier to stick with. The message here is that if you got an average rate of return of 8% over 3 years, and then you lost 8% in year 4, what rate of return would you have to get the next year in order to get back to an average of an 8% return? And the answer is 26.5%. So those investments have to work a lot harder after a big drop in order to get back to your average. The reason I take a look at this is just as we put this all together, one of the toughest things as an investor is to remove emotions. Diversification can help you stick with your investment plan, because if we are all invested in one asset class, such as U.S. large cap stocks, it can be pretty volatile. And for some people, that's fine. They can just put their money in and let it go. But depending on where you are in your investment journey, it may make sense to smooth that out a little bit and take some of the emotion out in order to be able to stick with your plan. So hope that helps. Let me know if you have any other questions, and talk to you soon.